Ladies and gentlemen, good day and welcome to Q1 FY26 earnings conference call of HDFC Asset Management Company Limited. From the management team, we have with us Mr. Navneet Munot, Mr. Naozad Sirwalla, and Mr. Simal Kanuga. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Simal Kanuga, who will give us a brief, following which we will proceed with the Q&A session. Thank you, and over to you, Simal.
Thank you so much. Good evening, everyone, and we hope that you had a chance to go through our presentation. Brief update on the industry. So the AUM stood at rupees 74.4 trillion as of June 2025, reflecting a 22% YOY increase. Equity-oriented AUM crossed rupees 43 trillion, up 21% over the same period. During the quarter, equity-oriented funds witnessed net inflows of rupees 911 billion. A quick recap here. First quarter of last financial year had net new flows of rupees 1281 billion, and for the full financial year, number was rupees 5544 billion. Almost all equity categories recorded net inflows during the quarter. In fact, this was the 52nd consecutive month of positive net flows for actively managed equity-oriented funds. Based on the overall improved liquidity in the system, debt and liquid funds recorded net inflows of rupees 1.34 trillion and rupees 609 billion respectively. Inflows in arbitrage funds added up to rupees 431 billion, and ETFs attracted rupees 264 billion. SIP flows remained strong, with monthly contributions reaching rupees 273 billion in June of 2025. The number of contributing accounts grew to 86.5 million compared to 67 million a year ago. SIP AUM crossed rupees 15 trillion and now accounts for 37% of the actively managed equity-oriented AUM. NFOs during the quarter mobilized rupees 65 billion across categories. The number of individual folios increased to 240 million, 26% year-on-year growth. Now we move to us. Our closing AUM crossed rupees 8.5 trillion with an overall market share of 11.5% and a YOY growth of 21%. Excluding ETFs, our market share was 12.8%. Actively managed equity-oriented assets grew by 19% year-on-year and crossed rupees 5 trillion with a market share of 12.8%. On the fixed income side, debt and liquid AUM grew by 22 and 17% YOY respectively, with market share of 13.3 and 12.6%. Our quarterly average AUM mix remained steady, with equity-oriented assets accounting for 64.2%. We added 0.5 million unique customers during the quarter, 500,000, while the industry added a million. As a result, our unique investor penetration now accounts for 25% of mutual fund investors in the country. Our systematic book crossed rupees 40 billion in month of June. The comparable number for June 2024 was rupees 32 billion. AUM under SIPs crossed rupees 2 trillion during the quarter. Our share of individual equity monthly average AUM for June 2025 stood at 13.1%, reinforcing our position as one of the most preferred choice among individual investors. Now to financials. Our revenue from operations grew by 25% year-on-year to be at rupees 9678 million. Other income grew by 34% year-on-year, aided by mark-to-market on both equity and debt. Total cost for this quarter was rupees 2144 million as against rupees 1959 million in Q1 of last year. Operating profit for the year grew by 30% year-on-year with a stable operating profit margin of 36 basis points of AUM. Our profit after tax grew to rupees 7480 million, a growth of 24% year-on-year. Thank you so much. Navneet, Naozad and I are here to take questions from here on. Nirav, we can start building the question queue, please.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from Shreya Shivani from CLSA India. Please go ahead.
Yeah, thank you and congratulations on a good set of numbers. I have 3 questions for you. My first question is on the yields for the quarter. Can you help us understand? Can you share the indicative yields across equity, debt, liquid, ETF segments, and also a commentary on why there has been a yield expansion in this quarter versus the previous quarter on QOQ basis? Why has there been an expansion? My second question is on the ESOP and the PSU plan that you announced in June, and there was one announced today also, but that was a much smaller one. Can you help us understand what will be the cost implication of that entire plan? How will it be split over the next 3-4 years? And how should we build our expenses going ahead? And my third question is on the new asset class. Where are we in terms of setting up the team, launching of the product, etc.? Any update on that will be useful. Thank you so much.
So first one, of course, the yields. So we can start with.
So I'll start with the yields. So the equity yields for the quarter broadly in line with the previous quarter, about 58-59 basis points for equity. Debt yields were between 27 and 28 basis points, and liquid were between 12 and 13. I think on an overall blended basis, we are at 46 basis points for the quarter, which is almost in line with what we have been having for the last couple of quarters. So it's pretty much in line, actually, not really any material expansion, I would say.
Somehow it seems like, okay, I'll get back, I'll check this offline, but it seems like there's a big expansion, more than 1 bip expansion in the quarter is what I feel, as per my numbers.
Right.
No, I think we can take it offline, Shivani.
Yeah, sure. Yeah, let's move to the next question.
Shreya, sorry.
On the questions on ESOPs and PSUs, maybe a bit of background. So in 2020, we had obtained shareholders' approval for around 32 lakh shares, of which we had issued 23 lakh shares at various points in time. That scheme provided for equal vesting over 3 years. So we have done away with that scheme, and the balance 8.7 lakh shares, which were not issued then, have been cancelled. So looking at the dynamics and the long-term orientation of the organization, we came out with a new scheme for ESOPs and performing stock units, which have a vesting of 4 years. The new scheme has a back-ended vesting of 10, 20, 30 and 40% for stock options over the first, second, third and fourth year. Similarly, for vesting of PSUs, it is vesting 30% in the third year and 70% in the fourth year. The NRC in their meeting on June 20th, 2025 had issued 10 odd lakh ESOPs and 2.28 lakh performance stock units. PSUs are not issued to nominees and its direct reports have been designated as HODs. And furthermore, PSUs are linked with performance parameters. So our estimate as per Black-Scholes suggests that the non-cash ESOP and PSU related expense would be between 205 to 210 crores over the vesting period. This, of course, is an estimate based on assumptions around attrition rates, volatility, and other relevant inputs. So the scheme would broadly result in a non-cash charge of about 56 crores in FY26, around 63 crores in FY27, 51 odd crores in FY28, 32 crores in FY29, and about 6 odd crores in FY30. These are again broad estimates as we speak today. There is also a stub of the residual cost of the previous ESOPs scheme, which was the shares issued earlier. That's around 14 crores, 11 crores of which is for FY26 and 3 crores in FY27. Again, I would like to end this by stating that over the last 5 years, we have recognized around 180 crores as ESOP related expenses in our P&L. And as you know, we continue to manage our overall costs and have also not shied away from investing in our business, hiring people, expanding branch network, establishing new verticals, as well as improving our digital infrastructure, etc.
Navneet, would you want to add on the ESOP overall thought process?
Sure. While Navzad has explained it in detail, I will just add that the HDFC Group has consistently championed employee ownership across its companies. At HDFC AMC, we have no doubt that our people are central to delivering consistent, sustainable long-term value to our clients and shareholders. So aligning employee interests with those of shareholders, clients, and other stakeholders is fundamental to Group's way of thinking. This reinforces our ethos while also responding to the evolving expectations of talent and the changing dynamics of industry. So I view this not as a cost, but as a long-term investment in building and retaining high-quality talent. Also, I would like to add one thing that under the new plan, ESOPs and PSU put together have been granted to over 800 people. That is 50% of our workforce across levels. So we are broadening ownership and deepening alignment. While the accounting charge is non-cash in nature, that Navzad has explained, so for FY26, if I assume an average AUM of, let's say, rupees 8.5 trillion, the estimated impact is well below 1 basis point of AUM, or to be exact, about 0.8 basis points.
The third question was on SIR.
The third question was on
SIR. So, Shreya, does this close your question on ESOP?
Yes, it does. This is the last question on SIR. Thank you.
Sure. Thank you. So on SIR, we have secured the necessary approval from SEBI to set up a specialized investment fund and opens up an avenue for us to launch this product. Our ability to launch and scale new offerings rests on the strong foundation we have built, a large and diversified investor base, and wide distribution network that enables quick and efficient market reach. Team is currently focused on designing a thoughtful set of offerings within that aligns with our investment strengths and risk management capabilities, reflect distributor and investor feedback, and offers a balanced risk-reward proposition to everyone. So I think I might have mentioned this earlier that our broader vision is very clear: to serve as a comprehensive investment platform offering solutions across mutual funds, which includes both active and passive, portfolio management services, and differentiated alternative strategies, which can meet the needs of a wide range of investors and a wide range of our partners.
Got it. And sir, just to follow up on that, is the hiring done for this team?
Certainly, we keep evaluating our investment capability, risk management capability, and the product capability. And I'm sure you would give us the credit given our long track record on that. I will also, add one line that we don't mind not being the first, but our focus is on being the best and doing what's right for our customers and all stakeholders.
Got it, sir. This was very useful. Thank you and all the best.
Thank you.
Thank you very much. Participants, you may press star and 1 to ask a question. Ladies and gentlemen, you may press star and 1 to ask a question. Next question is from the line of Ranveer Singh from HB Securities. Please go ahead.
Am I audible?
Yes, sir.
Yeah. So I had a question, we have around 8,200 crores approx in our balance sheet, and when I see the notes to account, 7,500 odd crores is invested in mutual funds. So what kind of mutual funds are these? I'm aware that you guys have to invest a certain amount in your mutual fund. Why I'm asking this question is to understand the other income better.
So these are largely in debt mutual funds, our own schemes. And we've given the breakup we give the breakup of the investments in the schedule to the deck.
You want to explain this? This is slide 29.
Yeah, the page 29 of the shareholders, the presentation we load on the website has the details. So what is the specific question? Because we already given the breakup. So the equity of the balance of the investment schedule, around 10% is equity, 7.5% is arbitrage, and the balance is in liquid and debt funds.
Okay. So this answers my question. Thank you.
Thank you.
Thank you. Next question is from the line of Centrum Broking. Please go ahead.
Yeah. Hi. Thanks for the opportunity. My first question is towards this HDFC Bank. I mean, HDFC Bank's contribution has kind of declined both in overall and equity. I know, in absolute terms, it must have increased. But why in percentage terms it can't increase, from the current levels?
Yeah, I think, see the pie chart that you're looking at, right? It is basically if other channels grow faster as compared to a bank, you will automatically see that pie chart shape up in the fashion it has. So it is not necessary that we are losing a share or anything in HDFC Bank scheme of things. But in terms of overall system, because of the way the fintechs are contributing in terms of SIP flows and others, direct as a proportion of that overall pie has been growing at a faster pace. So it is more of realignment rather than any kind of, it's difficult to kind of decide on increase or decrease based on what you look at in that data point.
Okay, but HDFC Bank sells all the products, right? There is no kind of restriction on that.
It is an open architecture, yes.
All right. And secondly, Billy, just wanted to know your outlook on debt and liquid. Basically, debt already had a good growth rate this quarter, and even the liquid schemes also had a great kind of a growth rate. So just wanted to understand, are we introducing first of all new products, and second, basically outlook for the entire year in terms of the growth rate?
I think the RBI taking series of measures to improve the liquidity in the system. I think the reduction in interest rates, CRR, all of that had a cumulative impact on debt market also becoming attractive for investors who are looking at yields which have kind of like can be on a downward trajectory. And I think overall favorable backdrop for the debt markets and by extension for debt mutual funds. I think all of these measures have been good for us. We remain constructive on the outlook for debt funds. You might have noticed that even at NFI, we have relaunched our campaign to promote debt funds.
Mm-hmm.
And I think whenever liquidity in the system improves, that also helps, and then people have positive view on the interest rate trajectory.
Okay. And any pipeline basically, for the launch of new products in this category?
I think we have best-in-class product range there. I think almost all the categories which are allowed by SEBI as per the classification are already available.
Okay. Oh, fine. Thanks, and wish you all the best.
In fact, in this quarter, if I remember correctly, the flows in the debt and liquid category put together for the mutual fund industry would be the highest ever for the industry as a whole.
Okay. Great. Thanks. Thank you so much.
Thank you very much. Next question is from line of Gaurav Jani from Prabhudas Lilladher. Please go ahead.
Hi. Thank you. Congrats on a good quarter. Just, taking the point forward on revenue, right? So my question was related to the yields. So the yields, of course, have been sort of flattish, but that's in spite of a strong growth in equity sequentially and also overall AUM, right, during the equity. So what would have led to this?
So Gaurav, this is, you would recall, right, we did some bit of rationalization in August of 2024. So you are seeing the impact of that over the last, so if you're looking at, yes, the yields have been flattish year on year with a similar kind of asset mix and increased equity AUM. Part of that can be attributed to the rationalization exercise we undertook last year.
Yeah, Simar, I get that. It's just that sequentially also, some of the funds would have sort of breached that CR level, right? I just want to understand, why is there still a static sort of reported yield?
It's basically a mix, right? What happens in terms of new asset sales or anything. Honestly, we would request you not to read too much into expansion of yields or anything, because that is not what we've been seeing. What tends to happen is certain other products get sold, some outgoing money would have been from a higher yielding or something. Mix of all of these things would have attributed, but there is no other specified reason for margins to kind of expand or anything. I think it has been exactly in the same lines as you pointed out, with increased AUM.
Understood. Sure. Lastly, on the other OpEx, right? There's been a sequential increase. Can you help us understand the factors that would have led to this, and could you quantify the line items, please?
Your question is between March quarter and June quarter?
That's correct. I think 74, 75 odd crores has gone up to about, it increased by about, I think, 9 or 10 crores.
Yeah. Some of it is timing of the CSR expenditure actually. Depending on how and when we spend our CSR funds, that moves the number. That's largely the material change.
Understood. Okay, perfect. Thanks so much. Okay.
Thank you. Next question is from line of Madhukar Ladha from Nuvama Wealth. Please go ahead.
Hi, good evening. Congratulations on a great set of numbers. Just, I wanted some comments around your net flow market share. See, SIP market share seems to have gone up sequentially, and you've done well there. If I look at closing equity AUM, that's up about 12.5% on a QoQ basis. Are we seeing slightly higher lump sum redemptions? Any comment around that? Probably on an overall basis, how are you seeing net inflow sort of market share shape up for you? That would be helpful. Thanks.
Our market share across all channels have been pretty healthy. That includes the national distributors, mutual fund distributors, fintech channel, investors who invest directly with us, RIAs, so on and so forth. We continue to get good shares both in lump sum as well as in the SIPs. The way you are computing, and we have always mentioned that the change in share that you are noticing would be on account of flows on one side and the mark-to-market impact on other side. Different funds would move differently, like you would see a difference between the way large caps would have moved compared to mid and small caps. Hybrid funds may have different amount of equity within that. It's a combination of many things. If the question is on trend in the flows, yeah, I mean, we see encouraging trends here.
On a quarter basis, are we maintaining our net inflow market share?
I think, Madhukar, we have always stated, right, we don't really necessarily comment on our net inflow share. I think as Navneet touched upon, I think our overall net flow market share is higher than our book market share.
Perfect. Thanks a lot. Thanks.
Thank you.
Thank you. Participants, you may press star and one to ask a question. Next question is from line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, hi. Just the question on yields again. Could you give us a breakdown on the yields? Is it similar to what we had seen in the previous quarter?
Yes, we actually did reply to that, but
Okay.
I can give it again. Equities remain at 58, 59 basis points. Debt is 27, 28 basis points, and liquid is 12 and 13. Very much in line.
Okay. Yeah. Also on the debt front, is there any flow towards the longer duration, or are we anticipating that? How should we think about this with the interest rate cuts happening? Do we see some traction already? Because I think the data suggests that at least the 1 year has started seeing some traction, but the longer duration months would see further traction going ahead.
No, credit to our fixed income team. They were highlighting more than a year back that those were the good interest rates for long-term investors, and we saw decent traction from individual investors and some of the other corporate investors in the long-term funds. But the recent flow that I talked about in the last quarter, they are largely at the short end.
Okay.
But as an industry, all of us collectively have been making efforts to ensure that industry has got good product range and a good offering even on the fixed income side. And mutual funds should not only be looked at as like equity investments by individual retail investors. We've been working very hard to promote fixed income also. And of course, some of the investors play fixed income through the hybrid funds.
Okay. Yeah. And on the SIF, do you need to have a separate investment team altogether, or your existing team can be utilized to do those as well?
No, I think a mix of both. I think from an overall investment team perspective, we have always mentioned that we have a deep pool of investment talent at our end. And of course, there is a lot of risk management and product capability that you need, which also we have.
Got that. Thank you so much.
Thank you. Next question is from line of Lalit Deo from Equirus Securities. Please go ahead.
Yeah, hi sir. Good evening. Congratulations on the set of numbers. Sir, I have just two questions. So firstly, like in the previous quarter, you mentioned that where we have seen some higher disclosures on the STP side of it. So just wanted to check like how is the current trend over there? Like have we seen some stoppage in the closure rate over there or not? Just some comments over there. And secondly, like on the alternative side, we have seen some good jump up in the overall AUM from around 5,100 crores to around 6,000 crores. So, like what has led to that sharp increase, and what kind of yields do we make in that segment currently?
So first question was on SIP accounts and closure, right?
The STP.
Systematic transfer plan, yeah. So that relatively is more volatile than the SIP flows. SIP flows are like very steady. People commit for much longer, and a large part of the SIP book is these days we are seeing longer and longer tenure getting committed at the beginning of the SIP when investors sign. On the STP, you may sometimes have investors who are kind of like investing in one debt fund or in liquid funds and transferring money from that over a period of time to equity or hybrid funds. Was that your question?
Yes, but that apart from that, they were like this is for a sequential basis actually. Probably due to the weakness of the markets also, there were some more closures like in the last particular quarter. But
so I mean, so when it comes to SIP, I would like to suggest to focus on two important data points that AMFI discloses. One is SIP contribution, and two is the number of contributing accounts. AMFI has begun disclosing the number of contributing SIP accounts, which provides a more meaningful view of actual investor engagement. So to give you numbers, the contributing accounts increased to 8.6 crore in June 25 compared to 6.7 crore in June 24. The contribution amount touches the new peak that you would have seen, 27,269 crore in June 25, which is up from 21,262 crore a year earlier. So that's a growth of 6,000 crores. So while some fluctuations due to account closure or pauses are to be expected month to month, the broader trend remains intact, and we continue to see growing interest from investors in overall systemic investing.
Sure, sir. Okay. Second question was on the alternative side, actually.
So on the alternative side, we have two things, right? One is basically we did a venture capital private equity fund of fund, which we closed last year with 1,200 odd crores of AUM. We also are currently in the raise mode when it comes to credit fund. The increase in AUM has also happened based on some of the inflows that we have seen under our non-discretionary portfolio management services account. In terms of yields, not very different as compared to our overall business.
Sure, sir. Yes. Thank you.
Thank you. Next question is from Devesh Punjabi from Banyan Tree Advisors. Please go ahead.
Hi, thanks for the opportunity. I had two questions. One was regarding the growth in the passive segment. We are seeing good growth over there, so if you could talk about the factors that have led to this. And two was around our strategy on launching new funds in the year, if you can touch upon that as well.
Patrick, you're talking about the overall industry growth or at our end?
At your end.
Okay. No, I mean, we've got the full product range, and I think we have been one of the oldest player on the passive side. Our first index fund got launched in 2002 and continues to remain one of the largest index fund in the country. Over the last couple of years, we have significantly expanded our product offering, both on index fund as well as on the ETF side. That includes market cap-based indices, smart beta, some of the sector thematic funds. So we've got the full product bouquet. We've got the best-in-class content and a seamless journey for investors to participate in that. We engage with partners who have been offering passive as their product bouquet. So trying to make every possible effort to ensure that we get our fair share in that space. On the overall view, product pipeline, so our current product suite is very well diversified. And as per the classification, we are present in almost all the categories that regulator allows. Within the sector and thematic category, wherever our investment team has a strong belief in terms of the product that we should offer, where we have the investment capability and we think that at least a set of investors and distributors would have a place for that kind of product, we continue to come out with that. Recently, we did this NFO of Innovation Fund. So I think overall our product bouquet has been pretty decent, and our endeavor is to keep gaining scale in each and every category and each and every product within that. So we have market leader in couple of categories, let's say balanced advantage fund or a mid-cap fund, flexi-cap fund, small cap. But our ambition is to build leadership across the board, each and every product where we are present. Given the long-term track record, given the investment capability, and given the reach that we have, want to ensure that we have leadership in every product where we are present.
Oh, okay. Thank you, and all the best.
Thank you.
Thank you. Participants, you may press star and one to ask a question. Next question is from line of Dipanjan Ghosh from Citi. Please go ahead.
Hi, sir. Actually, going back to one of the participants' previous question where you mentioned that your flow market share across most of the channel partners have been healthy. But I think the similar question was, the equity-oriented market share has broadly been stable over some time now. And if I look at, one of the reasons you pointed out is obviously the differential mark-to-market and composition of schemes within the equity-oriented bucket, which is fair. But if I look at, across schemes, it would probably be some schemes, let's say, some of the schemes where market share has kind of been down a little bit over the last 6-9 months. And maybe some other categories where market share is probably a little bit up on an AUM basis. So, the question really is, if you were to look at flows that you have seen over this past quarter, over the past 9 months or maybe 12 months, has there been any sort of skew towards the categories, let's say, where your concentration within the portfolio, let's say, some of the categories where you are relatively more dominant or the mix of those categories within your portfolio relatively high. Has there been any sort of skew and X of that, how are you seeing the flow trends across different scheme categories? Not quantifying in terms of the trajectory.
The flow trend has been pretty healthy, Dipanjan, I mentioned there. But on the mark-to-market side, if you look at like last 1 year, different indices would have performed differently. And again, as I said that within the hybrid funds, depending on what the equity share you are running and the impact on the mark-to-market on the fixed income side also can have some impact on the way you look at the share. But otherwise, on the flows, I can tell you that it's been encouraging.
Got it. But Navneet, totally fair to assume that let's say across most of the large categories within the equity-oriented side, the flow market share has been holding up. If I were to kind of look at each individual category separately, just on a flow basis.
By and large, yeah, as an asset class. I mean, within that, different funds, in some of the funds, we will have exceptionally high share. In some of the funds, we would have slightly lower share. But if you look at equity as an asset class, would be higher, yes.
And Dipanjan, if you are referring to holding up, definitely yes. I think we have not seen a loss of share in any like a large category.
Got it. Thanks, Navneet. Thanks, Amal, and all the best.
Thanks, sir. Thank you.
Thank you very much. Next question is from Abhijit from Kotak Securities. Please go ahead.
Hey, hi. Good evening, everyone. So I have a qualitative question. So like when we look at the portfolio, we have a really large, balanced fund, which has like a defensive characteristic, and then, slightly outsized exposure towards, the small and mid cap fund. So as a franchise, is it possible, or do you kind of, intend to move money around of the customers, across cycles whenever you kind of want to slow down flows in some of the smaller and mid-cap categories? So generally, the distributors take that call, but as an AMC, how do you really, capture the existing relationship and be able to, move that money across some of the other funds within the fund house itself?
We don't do the asset allocation on behalf of our partners or on behalf of our investors unless it's an asset allocation product. So in dynamic asset allocation, which is the Balanced Advantage Fund for us, the fund manager would do some bit of allocation within the template that we would have or in a multi-asset fund. But otherwise, we express our views. Our fund managers express their views on different asset classes within that, different categories. At different points in time, the fund manager of mid and a small cap, which is Chirag, would be expressing certain views, while other fund managers may have a different view on what they think about the large cap category or a particular sector or a particular theme. Then it's completely up to the partner or the end investor where they want to do money. We don't give like very aggressive calls on investors should shift money from this place to this place. We have always believed, and if you look at several of our funds which have got track record going back 20 or 25 or even 30 years, I think our belief has been investors keeping their money for the long run. Having that strategic asset allocation has kind of like has delivered the best possible results. Too much of that tactical asset allocation and trying to react to every, I would say, market move doesn't really result in the best possible wealth creation for the investor. That is what our experience of last 25 years suggests, and this is what we keep guiding our partners and investors.
Got it. And then just a follow-up, like do we have any number or do we kind of track the number of products per customer, or is there a correlation between once you have, a customer holding more than one or two funds, the relationship tends to be, a more secure one?
Yeah, endeavor, as I mentioned earlier, in a different context, that we would like to optimize or maximize our share within each and every category, and that includes both, getting new customers and of course, kind of like offering other products to the existing investors.
Okay. Got it. Thank you.
Thank you very much. A reminder to all the participants, you may press star and one to ask a question. As there are no further questions, I would now like to hand the conference over to Mr. Navneet Munot for closing comments.
Sure. To summarize, our closing AUM crossed 8.5 trillion rupees. Systematic transactions, which includes both SIP as well as STP, that stood at rupees 40.1 billion in June 2025, and we added 0.5 million unique investors during the quarter. I would reiterate also our mission and vision. Our mission is to be the wealth creator for every Indian, and our vision is to be the most respected asset manager in the world. Thank you.
Thank you very much. On behalf of HDFC Asset Management Company Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.